Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. Andrew Kuhn, Focused Compounding, sitting alongside my co-founder, Mr. Geoff Gannon. Jeff, how's it going today?
It's going great, Andrew. How's it going with you?
It is going wonderful. We hope it's going great for everybody else. We are back in Dallas, first time since our Willow Oak event. I just wanted to give everybody, or just say to everybody really quick, thank you so much for all of the emails, tweets, DMs. I know you also got a lot of that as well. Just a bunch of love letters wishing us, congratulations and good thoughts. And we really just want to say thank you so much to everybody who reached out to us. Obviously, Focus Compounding has been a lot of fun for us, and it's just the next step down the road. So we're certainly excited to get going with Willow Oak. In today's video, we are going to be going over mistakes that investors will always make, or we could say just certain biases that investors, fall prey to, and that they'll always kind of fall victim to.
Right.
And this idea came up because somebody asked us a question if we invest in Reits.
Yes.
Which we don't. And I thought it would be a fun video and podcast to go over this, because one of the most popular podcasts we've ever done was actually the common mistakes investors make.
Yes.
So I thought it'd be, really fun and to sort of go over it. So why don't you invest in REITs, and why have you always stayed away from REITs?
Yeah, so there's nothing wrong with all REITs, but the reason that I was kind of saying, this is a good question, but I'm not going to really have an interesting answer for it, is that there are certain things that I think, certain securities that I think appeal to investors and to certain groups of investors, and sort of they get overpriced as a result. And actually, I had gotten that email about the REIT thing, and then when we were at the Willow Oak event, there was a question they asked while I was on a panel thing there, saying like, well, here are the biases that people have. What do you do to fight those biases and overcome them? And everyone had good answers and stuff, but I didn't give an answer because my answer would basically be, I think it's really, really hard, even if you know the bias, to actually overcome it.
Sure.
So I think you can know there's a bias and you can still fall for it over and over again. And we'll see that here when we talk about these things. I think if you find yourself doing some of the things we're going to talk about here, you're probably going to do it again even after you've listened to this episode.
Yeah.
So, but we'll see.
Yeah.
We'll see. At least you'll know what mistakes you're likely to make. So REITs, the reason really is that I think people overvalue income. I know that. I get lots and lots of emails.
Now, like from a dividend standpoint?
Yes. Same. If they got the same income, if you told people that you can make 10% a year in stocks, and then you can sell it to produce your income, all in capital gains. There won't be any dividends paid out to you. And then you can sell a portion of that to fund something, like say you were creating a trust or for a foundation or an endowment for a college or whatever. People would prefer to get it in income than having to sell something to produce that income, right? And there's some disadvantages from a tax perspective to selling stuff with having to pay taxes and stuff, but it's not a very big disadvantage. And so people really overvalue the income being paid out to them in a dividend or something like that. Now, in a lot of companies, they're retaining half their earnings or so, and they're paying out the other half in dividends. That's fine, and it's a fine way to get income that's left over. But in a structure like a REIT, what's often happening is they're paying out virtually everything. And in fact, they're really, if they're going to grow or something like that, they're going to issue additional shares, they're going to borrow, they're going to do things like that. So they're paying out, to my mind, sometimes more than they actually have in cash from like an owner's earnings perspective. So it would be the equivalent of like if you had a stock that we were investing in or whatever, and they're paying more than 100% of their earnings out in dividends of their real free cash flow. So I think that it's just a way that they know that people value income much higher. So let's say a stock had a P of 10. We can find stocks that have a P of 10, but good luck finding a stock that has a yield of 10%, right?
Sure, yeah.
And think how risky some of those stocks are with a yield of 10% versus how safe some stocks are with a PE of 10. We can find safe stocks with a PE of 10.
Yeah.
They're unpopular for a very various reasons, but they're not in grave danger of having earnings go down a lot. But anything I can think of that's yielding 10% right now is in serious danger of cutting that, right? And people get attracted to it all the time, and then they're going to cut it, and you're going to be down to 5% or whatever. So that happens all the times with REITs, more so than anything else, because they're created almost from birth, publicly traded ones, to be something that is basically just like a vehicle for income. And particularly now in the last 10 years or so, with interest rates so low, people really reach for that income and things like that. But you can see that even like bonds. Some people are investing in government bonds, and government bonds are an inferior investment choice to even corporate bonds and things like that, because people pay too much for risk-free interest, basically. So they bid it up to too high a price, the yield is too low. And so over time, you're just going to perform worse by doing that. And it's just certain income is something that people really overvalue. I mean, do you find that to be true?
Sure.
That like, look, if you told people, like for instance, if you had a product that was like, we guarantee that you'll get this much from this insurance company or whatever, they're going to value that at a really high value compared to like an uncertain return in the S&P 500 over decades. Yeah.
Mm-hmm. And I do think it comes from, though, like at what point in your what part you are in your life, quite honestly. Like if you're in retirement and people they want that predictable income stream, that could be different than somebody that's 34 years old who is looking to just grow their money as fast as possible, or as much as possible, I should say. But
the difference is what happens is, so like say government bonds yield 3%.
Yeah.
All right. Well, they decide I need more than 3%. Instead of just saying, oh, well, I can only get 3% that's guaranteed, they start thinking, well, what can I get that's 6%? But what you can get at 6% is often more dangerous than a stock.
Oh, totally.
And so you have to be very careful about doing that.
I know an individual who he was, he owned a bunch of bonds. He said, and I forget what they were yielding, but north of 10%. And upon actually doing due diligence and looking at his portfolio, he owned a bunch of junk bonds, just like terrible companies. Yeah.
Yeah, and I mean, if you would invest in the stock of the company,
which, by the way, it's not like he was a fundamental investor at all. He was just attracted to the yield on paper. Yeah, it wasn't like, there's some individuals that they specialize in sort of that distressed space, and maybe they take a little bit more of a fundamental, investing point of view to it, where it's totally different. They're very, competent, I guess, in that industry or that way of investing. This gentleman, he was just very, big-eyed towards just the yield that he was getting. Yeah.
But the problem is that when you have the PE ratio, often people aren't as attracted to that, the earnings yield. So like if you have a bond that yields 12%, people are really excited by that in a way they're not for a PE of 8. Even though the PE of 8 really is telling you much the same thing in some cases as that bond. It's not guaranteed in that way, but often the quality of what you'll get is a lot safer. I mean, there are stocks that trade at earnings yields of 12% and have no debt. If you try to find a bond that yields 12% right now, you're going to see some seriously poor coverage of the interest that they're paying out, and it's very risky. Yeah, so I think that people reach too much for income compared to the same amount that they could get from capital gains, from buying something, getting the capital gain, and selling it. Income, if it's as safe as the capital gains that you're getting, there's nothing wrong with that. But I think that people equate the two in a way that's not appropriate. You can often have a much safer capital gains than what they're reaching for in terms of income.
What do you think about MLPs?
Same sort of thing, yeah. So, I mean, there are some that are better, but it's still the same structure, I think. I mean, some things here are also how it's marketed to investors, why it was created this way and everything. The best position is usually not being the limited partner, it's being the general partner.
Sure.
Yeah. So you have to wonder, why do I want to be invested as a limited partner when there's a general partner who's probably making more off of this? And I think, honestly, the distributions are a big part of that. People are buying it for the income.
And it's totally interesting, too, because I knew a product that was at a wirehouse. I won't say the name of that. I knew a product that was more on the independent side, so they don't operate through a wirehouse. And the product on the independent side was a little bit better, the same exact product, for the investor than at the wirehouse, because there was less mouths to feed in between, so it wasn't as watered down. Isn't that kind of interesting?
Yeah, and that's always one thing that you want to flip around when we're talking about any of these things is, okay, I think people are very focused on like, I want income. Okay, that's great. But whenever you're looking to buy something from someone like that, you want to think, well, what are they getting out of this? It's even if it was like, your insurance or something. Well, if it's car insurance, you need it. So that's the situation that you're stuck in. But in other forms of insurance, it's like, well, why are they giving me this rate? Because it's a bad deal for me. But if I need the insurance to smooth things out, to protect myself in the worst case, okay. But I should understand this is on the odds a bad idea what I'm doing, and keep that in mind.
Yeah, I mean, and the common theme in both of these I guess products that we're talking about is they're highly commissionable products too,
Yeah.
which is kind of interesting.
Yeah.
How that works. Yeah.
Yeah, I mean, I was at a car dealership looking at cars and stuff with someone, and I was like, so of course people are focused on what their interests are, and they're like, oh, but I really want to get this today or whatever. And,
Yeah.
and I'm like, yeah, but then we're going to make $500 today, the moment they sell you that loan with it, they're going to go, they don't care if you pay the loan or not. They're getting that, amount of money off this. And if you walk out, they've just lost a prospect that they would pay a lot to have that chance.
Sure.
They don't know someone else is walking in here now. So you want to always think about the incentives from the other side that way.
Totally.
So why are they structuring the product like this? In a lot of these cases, I think it's because by distributing stuff to you in cash consistently, they can get it can be much more highly priced. So the same amount of money retained by the business would have a much lower PE than what you're getting in terms of like price to dividend by paying the stuff out to you. A dividend is just you're valuing it too highly compared to other sorts of things.
So if you were to structure a portfolio that the point of it was for income maximization, taking
Right.
income from it for maybe somebody that's in retirement or
Yeah.
whatever, how would you structure that portfolio?
Well, honestly,
We're not CFPs.
Okay. Honestly, in the long run, I think that you're usually going to be better off by having capital gains.
Got it.
So
it's
selling off
truly-
a portion. Yeah.
Got it. Mhm.
Yeah. So if that means that you have to sell off 5% of the portfolio at all times, you're probably going to have a better return that way. That's true even if we're talking about things like, for example, junk bonds. Safer, better returns in junk bonds or in a junk bond fund or something is going to have a significant component of capital gains as part of it, actually. It's going to be that the bond was trading at a lower price versus par than what it actually ended up at when you got out of it or when it matured. So I think that that's also part of it too that way. It's even like when we talk about things, we've talked about Timberland before or something. It may be one of the reasons why that I think, Timberland's a good example. I think Timberland has often been priced really attractively versus bonds. And that's kind of silly because people really want to, generally people thinking about retirement or something want to preserve their real purchasing power.
Sure, yeah.
Right? So it's if they want to make up inflation too. The bond is not protecting them in terms of inflation, and yet they could get this return in Timberland, but it's not all coming in the form of cash being paid out to you. It's being, a significant amount of is capital gains and things like that. And but it's a good alternative and something that should be in there with bonds or in a substitute to certain bonds, I think. But good luck selling people on that idea.
What about IPOs? Why don't
we
ever
don't
buy IPO?
ever.
Have you
Yeah.
ever bought an IPO?
No, never.
And
I've
why
a
is
couple
that?
times looked at IPOs afterwards.
Now, is that because typical investors that you follow, Warren Buffett, he
Yeah.
says that they've never purchased an IPO. Are you like totally turned off by IPOs in general, or what is it?
Yeah, I'm totally turned off by IPOs in general.
Why is that? So you're not buying WeWork.
Correct. Yeah, and that's why, because everyone knows about WeWork and stuff, because it's gone badly so
Yeah,
far.
yeah,
When we're recording this, it's not going well. But they've put out the whole story, they've created the buzz around it and everything. It's the worst time to buy something. So you're getting the same thing. So let's say you buy the stock today or you buy it in a year or two or something. It's the same stock. It's the same thing that you're owning. But at this moment, there's going to be an artificial sense of scarcity. There's going to be stuff that's locked up. They're only going to do so much of it, whatever. There's going to be people who are concerned, what if I don't get in the first day? So there's an urgency to it. So it's as if there's some department store that's saying, we're only going to have 15 of these items. First ones in the door are going to get it. We're cutting the price by 50%, but tomorrow goes right back up to that old price.
Yeah.
That sort of thing. It creates all of that atmosphere.
Sure, yeah.
And then there are other things about it that create an atmosphere more like an auction, where then people are watching it go up in price when that happens, and they're focused on the price action that way.
Yeah.
It's going to get, they're going to make sure that there's all this stuff covered in the press about it and everything. So it's just you're going to get one of the worst prices that you'll ever get for the stock. Some IPOs perform fine, so that they are more expensive in the future. The stock goes up, and you'd have to pay more in the future. But in terms of, we focus on overlooked things, and I think spin-offs are a good idea because they're likely to be the reverse, where there are advantages to the buyer and the seller is in a disadvantaged situation. Here we have the opposite. The seller is not at all motivated to sell usually. Now, sometimes that's not true. WeWork needs capital, so they might be. But in many cases, when a company IPOs, they don't really need the access to the capital. There are some examples I can think of where they really do. But so if it doesn't go well or something, they can just move it to another time. They're picking this particular time because they think this now is the best time to sell it. It's overvalued and stuff.
Sure.
So it's as if, think about if you're
that's essentially what they're doing when you think about going back to the incentives, right?
Yeah.
When they're taking a company public, it's because they think it's the most valuable time for it to go from their perspective to sell it to the public.
Yeah. Well, I'll give you an example. Okay. Who would you not want to buy a house from? You don't want to buy a house from someone who is a real estate broker who owns the house. That's the worst person to buy the house from. Sure. So they know the market and stuff. They will actually wait and leave their house on the market longer than they would probably even for their own clients, let's face it, because they're 100% invested in this, whereas they only are invested in the commission for other ones. So they're going to work the hardest to do it. They're going to, if it's a bad time for the market, they're going to take that house off the market. They're going to be very focused on getting the best price that way. And that's what you're dealing with an IPO, is you're dealing with some of the most informed people about the market, what the demand is for it. They felt all this stuff out before, and they've decided now is the best time. Well, if the seller thinks now is the best time, for the buyer, this is the worst time. It doesn't mean that the companies might not be great and turn out to be amazing long-term investments. They might be, but a year from now is probably a better time to think about it. So I have looked at busted IPOs before.
So like what? From the second they went public?
Ones, one almost from the moment it was an IPO, because it was a weird one, was a company called Open Table. It was eventually taken over. But it was a weird one because it decided to go ahead with its IPO even though it was like a bad time for IPOs. Yeah. So that was a weird one. Did you buy it? No, I did not. I wrote up stuff about it. Yeah. I think Booking eventually bought it. I'm pretty sure. I can see that. I think they had an impairment on it. And then the other one that recently that I saw that was really amazing to me was Funko. Do you know this company? No. Okay, so if you go to like a GameStop or someplace like that, you'll see their little figures. They're like $10 and less figures. They're not even action figures. They're just collectible things that don't move and stuff, Nice. And they're either vinyl or plastic. And they're like, they'll have Game of Thrones characters or something like that, right? And they coincide with like a major release of things or just what's in the pop culture kind of stuff, right? And it was remarkable how badly it went after the IPO, how cheap it got. And I talked to some people who bought those sorts of things. I looked at the different places that it was and stuff. It seemed like it was going to grow quite a bit and stuff. So it was interesting. I mean, it was not at a price that a value investor would buy, but it does sometimes happen that there are these weird things where I don't know why it went that badly and stuff. But even then, same way, you probably got a better price a few months later or something than buying in the IPO.
Got it.
It's great to learn about them at the time of the IPO because that's the most information you're ever going to get in those filings and stuff. And so I read those filings, but don't buy the company.
I mean, I read the filings too because a lot of the companies that go public today are more like, tech oriented. And even though we don't invest in a lot of those types of companies, I still enjoy reading about them and learning about them and seeing, how they sort of, make money and stuff like that.
Yeah, and so there's a very extensive filings that you can go and find on Edgar.
Leverage ETFs. What is your opinion on that?
Well, that's a good example of just something, a bigger class of things that I think is a mistake investors will make like all the time, which is, so that's something which over a long enough time horizon will be worthless, basically, because it's leveraged. That's the reason why. So if you have something that's going up and down like that and it's leveraged, over time you're likely to do what they call gambler's ruin, which is that you will eventually cross zero. So you'll basically, even though over time you might think that on any given day your odds of going up or down are good enough that it's a good investment, if you compound those over time, you're going to find that while crossing, being up 100% doesn't mean anything. Being down 100% means you're broke. It's over. Yeah. So, and there's a good book about that. There's a good book that covers a lot of that, which is, actually, the one that I liked a lot was A Man for All Markets, but also I think Fortune's Formula covers some of that. And that's the Kelly formula and all that stuff. So what the Kelly formula really is telling you is people take it as like a betting formula of what you should be betting, but what it's really telling you is the maximum that it's safe to bet, beyond which you would run a risk, even if you were right about all your assumptions, of still going broke. Yeah. And that's what I'm talking about here. So there are instruments that people like that are dangerous because of how volatile they are and how likely they are that you could end up losing everything in them, even though it might seem like a smart idea just on the odds. And the biggest reason for that is always leverage. So it's the same thing with borrowing on margin. It's the same thing with there are other ways to do certain leverage things, and they all potentially have that risk. And I think people need to think about that, about how can I go broke while being right. And some of these things you can go broke while being right. And so, and I think people don't. They like the upside to it, and they think it's a smart investment, but they don't realize that it's not the same as a stock investment in which you're like, here's an example, S&P 500, whether you buy at a really high price, really low price, no matter what happens with the economy. The risk that you'll go broke is nothing.
Sure.
Because of the diversification.
Like to go to
of it.
actual zero.
It won't actually go to zero. You can lose 90%, it'll recover from that. You want to always ask yourself, is there a way that this can get to a point that I can actually lose everything I have in it, that I can't recover? Is there a way that you can't recover in this? And that can happen even with a company that's very, very highly leveraged. Same sort of thing, that if it defaults, the company will eventually come out of bankruptcy and be successful if it's a good business and you know that. But you, as the shareholder, could end up with nothing. So anything that, can I go broke in this? Is there a way for that to happen? Yeah.
Sure. Saving on taxes.
That's a huge one. So saving on taxes and also just saving expenses on things too.
Yeah.
I got that a lot with a big reason why people would pass on Japanese net nets is that they would have to switch brokers, or if they didn't switch brokers, their broker would charge them like $100 to do it. So they didn't want to do it. You could probably have a diversified, portfolio of like 5 net nets or something for $500, depending on how much you're putting in it. If you do the math on that, what people don't like is if they saw that and said, well, that's 3% of what I'm putting in. That sounds so high to them, used to like brokers now and stuff, where it's like nothing, that they don't want to make the investment. But, if the stocks return 30 or 50% instead of 10%, it's kind of worth it to take that.
Yeah.
Same sort of thing on taxes. Buffett wrote a great thing in his partnership letters about it. And he said, here are the ways that you can save on taxes. And he went through them, and he was like, which of these sound appealing to you? You can die with the gain. You can lose the gain the same way that you got it, and he went through those things. I think a lot of, for whatever reason, I don't know what it is, people not making a certain amount of money in the market, like having a somewhat worse return, doesn't hurt them in the same way that paying that in taxes does. So if they made 10% a year instead of 15% a year, somehow that doesn't feel as bad as making 15% a year and paying a third to the government.
Yeah.
Do you find that to be true?
Sure. Yeah.
Yeah.
I mean, there's a lot of things that, and just like customer buying habits that are very much like that.
Yeah. And I think, so it's the certainty of it, and then it's a loss, that you're giving to someone else. I mean, we're talking to someone who was like, talking about how you think about how different institutional investors and stuff think about like management fees and stuff. And they were like, well, because the profit share fee isn't that certain, they're more okay with it. But then if there's a management fee, then they're like, oh, but that's 1.5% instead of 1% or whatever. It's very certain.
Sure.
And that's sort of the same thing with taxes and stuff like that. Whereas it's fine to save on taxes, other things being equal. But sometimes people will do dumb things like, are you selling something you shouldn't sell because of taxes? Or are you holding on to something that you really shouldn't hold on to because you're trying to avoid paying a tax on it? Like, that's one of the worst ones that I see, is that people are like, well, I have to hold on to this because if I sell it, then I'm going to have to pay these taxes on it. Yeah. Which, if you think it's the business is good and whatever, that's fine, doing nothing. But it's fine not to turn your portfolio over into other things. But if it's like, well, it's getting a little riskier than what I originally intended, but I don't want to pay the
You're making
tax.
the decision to not do anything strictly because of taxes.
Yeah, I mean, that's not a good reason to do it.
Yeah.
The only time when it would make sense, I think people are mixing something up in their head, which is that I should want to save on taxes. Yeah, you should want to save on taxes if other things are equal. Same things with fees in portfolios and things. If your choice is between a Vanguard and some other thing that's very similar to Vanguard's S&P 500 index thing, and it pays even the slightest higher fee, then you should obviously choose on the basis of the fee. But you shouldn't say, oh, it's somewhat a worse mutual fund. I don't really like the manager as much, but the fee is a bit lower.
Yeah.
I mean, that think about how dumb that is.
Sure.
And it's the same thing with taxes that way. But people do it because they're like, oh, by doing this, I save. But you bought something worse. It's kind of like if you went to Walmart or whatever, and you're like, well, I saved so much by buying the this great value brand or whatever. Well, if it's disgusting, then you didn't save anything.
Worth. What about shorting good companies? Where they short pretty much just on valuation alone. So they'll take like a company that is let's say like a blue chip company, and they say it's trading at 30 times earnings and it deserves to trade at a market multiple or whatever. And that's their basis for shorting. What are your thoughts
we
on
talk
that?
about how we don't short. But and that is true. We don't short at all. I mean, I shorted before to hedge something, but I don't short. But if I was going to short, the one thing that I won't argue with that it makes sense is to shorting fundamentally business models that don't work and stuff.
Frauds.
And frauds, absolutely frauds.
Uh-huh.
Frauds, fads, any of those things.
Yeah.
It makes sense to short them if you think they're going to zero. Fundamentally bad businesses that might go to zero. What some people do, though, is they short, and I think this is very attractive to certain value investors, and especially people who feel like they're more advanced investors now and stuff, is shorting things purely based on the valuation. And that's where I think it doesn't make that much sense. And I was talking to you about that.
Because it's a very hard game, is what you're saying.
Yeah. Well, I was talking to you about that specifically with a couple companies. Like I years ago invested in a company, J&J Snack Foods. I had looked years ago at McCormick, which does spices and stuff. And I noticed that both of them were written up as shorts on Value Investors Club. They're very expensive. That's why you would short them. But they're very predictable, snack foods and spices.
Sure.
And those are like leading companies in those areas. Like J&J Snack Foods, if you eat a soft pretzel pretty much at any event in the U.S., you're like at a baseball game or something, you eat a soft pretzel, it's probably theirs. It's Super Pretzel is their brand. Icy is another brand of theirs that people probably see. That's probably one of the better known like ice slushy type things. Those are pretty predictable things. And there's an expense to shorting.
Sure.
Because you have to borrow. Yeah, the cost to borrow. Many companies are talking about paid dividends, which is an extra expense that way. And then you have the opportunity cost that we're talking about in terms of you're shorting something instead of owning stocks which tend to go up. And if you think about it, like the market tends to go up, whatever, let's say 8% a year or something like that over time. Even if you think the returns might be a little bit lower than that, even if we were to say, okay, we think the S&P will do 5% a year over the next 10 years. By not being long stocks, you're also running the risk that on average they'll go up 5% a year. And so even if you're right about valuation, like say it's at 30 times earnings and you're saying it should be at 15, that might be true, but actually the earnings are going along at 5% a year or something, right? And then you have a dividend, and then you're paying something to borrow this. I mean, when you add those things up, it just doesn't make a lot of sense to me.
So I guess like the bottom line is, if you're going to short on fads and frauds as opposed to just valuation alone.
Yeah, and definitely don't short like companies that lead in their market and all those things.
Yeah.
I mean, you might make money in a downturn, but I think you can do that just by shorting.
Here's the thing, right? Like J&J Snack Foods, and maybe it's not the best example, but if something were to, if the business were to sell off like crazy, another company would buy them.
It's possible.
So you have
absolutely.
that. And we've spoken about this before in the podcast too, why it's so hard to short is because there's so many incentives for a business to succeed. I mean, look at like Berkshire Hathaway, for example.
Yeah.
Right? And maybe that's a bit of an extreme case, but there was a lot of incentives for that company to succeed. Buffett had a huge, interest in it.
Right.
And who would have thought that this textile manufacturer would have became what it is today?
Yeah. And I was talking about it was something else where I saw a company that not that many years ago had a fundamentally challenged core business that it was in, right?
Yeah.
But what they did is they were getting free cash flow from it. And so they took that free cash flow and they invested in other things. So they had like an old tech sort of thing. But what ended up happening is that over a few years, they ended up owning all this stuff that's like this online, very, what the internet's like now thing.
Yeah.
The people shorting it never could have predicted that. But they should have been careful because they were shorting something that had, free cash flow that was 10, 20% a year.
Sure.
You can take that free cash flow and do smart things with it,
Mm-hmm. Got it. Another mistake that investors always make is they read a lot into the short-term swings of the market.
Yeah.
What are your thoughts on that?
That's a huge one.
Or the stocks that they're following. What are your thoughts on that?
Yeah. And the stocks that are following, my favorite one, of course, is that like before they own the stock, they have one way of thinking about the stock, and then once they own it, it means something different.
Sure.
Because they're actually only paying attention to the day-to-day swings.
Yeah.
And that's exacerbated by things like Twitter, message boards, things like that. People can ask each other, why is this happening? Why is this going down or whatever? We were talking about this because we were talking about a stock. And you were like, why do you think, why do you think that it went up or whatever? And I said, well, I mean, I can tell that why it was going up is because there's now less selling. There's less supply of selling.
Wise guy. Yeah,
and so the bidding went up. No, but you're saying that I was being a wise guy, which is true, that basically all we knew is that there's more,
totally.
There's more bidding than selling. But in that case, actually, we had reason to believe that there had been someone who was selling a lot and that they were done selling.
Yeah, exactly.
And that's why it started going up.
Yeah.
Now, I don't know that the people investing in stock necessarily know that. In some stocks, we're a large enough owner that it might matter if we were selling 1 week and then we were done selling our stake, or if we decide to stop selling something. We've decided to stop selling something not because it has anything to do, stop offering to sell. Not because it has anything to do with the stock, but just because the only reason we're offering to sell is because I found something totally unrelated that's better to buy.
Yeah. Mm-hmm.
So suddenly we're willing to sell a large block.
Yeah, not because we dislike the company or anything like that. Yeah.
So someone would be watching that and say, oh, suddenly someone's offering way more than a day's volume of the stock and they're willing to sell it, but then no one took them up on the offer and then it went away. Why did all that happen?
Yeah.
Well, it happened because we wanted to buy something else. We weren't willing to lower our price. no one came up to our price, and so then it went away. That but that's all you know about the stock price is the supply and demand of people buying and selling it. That's what's really determining the price and the price movements.
Yeah.
And people read all this other stuff into it. What do I think that everyone thinks about this? And why did it move this way or that? And a lot of times it doesn't make a ton of sense. I mean, our biggest position is NACCO, and this year most of its earnings have come from natural gas. But I was pointing out that if you looked at it on a day when all these natural gas companies were up a ton, it was up a little bit, no difference. So does that mean that people don't know that it's involved a lot with natural gas? I don't know. Does it mean that people, when they want to bet on natural gas one way or the other, go to the companies that they recognize and buy those and stuff? Does it mean that it's a little less liquid and so it's not attracting like traders and stuff?
Yeah.
And so that's not what it is? I don't know. I can't say based on those things, but you can see that it's not reflecting the underlying fundamentals of the business is changing that much. And there's a ton of that now where people read into like, why did a move happen?
Sure. It's kind of like Greenblatt when he said, why does value investing work? And he says, I don't know. I don't care. I just know that's going to continue to work over time.
Yeah. Yeah. I mean, you really don't know anything about it from that. And the things I think are funny are when you have these media things, where they're always saying like, two things happened that day.
Yeah.
Like, oil was up and stocks were down. And so they said, stocks fell because the oil prices rose today.
Yeah.
Or take the yield curve, the inverted yield curve, stocks reacted badly because the yield curve was inverted. Maybe, but why is the yield curve inverted? They don't explain why that's happening. There are also supply and demand reasons for why the yield curve would be inverted.
Sure.
So you could take that to each thing of, okay, well then why did that happen? Why did those things are related, I'm sure, but they're not. The idea that one thing causes the other like that,
Sure.
And sometimes there's just a chance that if no one had any information about new information about a stock, but people traded it every day, it would still fluctuate a little bit. If we were all in a media blackout where we couldn't know anything about NACCO or something, right? And you took all the sellers and all the buyers and put them in one place, and you soundproofed the room and whatever, they can't find anything out and any new information out. On days, it would go up 2% or down 2% sometimes, and there was no there may have been news in the world, but those people in that room couldn't have known it, but it would still happen. So it would still follow, a random walk or whatever, no matter what. But people are going to read into that something that's a lot.
They know something I don't know.
Yeah, exactly. Yeah.
Got it. Cool. Well, I want to thank everybody so much for tuning in with us here today. Be sure to check out our YouTube videos. Subscribe there. I'm pumping out 3 videos a week on everything investing related, having a lot of fun doing it. Follow me on Twitter at Focus Compound, and then sign up for Geoff's weekly Gazette that goes out where we give away a free overlooked stock. And I think everyone they got this past week.
We give out the idea.
Yeah, the idea.
We don't give you the stock, Yeah,
the idea. This past week that you wrote about was a very interesting idea. It's not going to be up on our website for a couple weeks maybe or so.
Yeah.
But definitely check that out. Go to focuscompoundinggazette.com. I want to thank everybody so much for tuning in with us, and we'll see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.